Everyone watching Dell is asking the same thing right now. What the hell just happened? 32% up in a day. FOMO is screaming. But is this real or just a squeeze? Dig deeper. Smart money isn't just buying. They're piling in at 108% above normal volume. That's not retail chasing memes. The lab ran the numbers. Lab score, 71 out of 100 by. Dell's hardware dominance hinges on a brutal physical reality, managing a 120 kilowatt thermal wall of system heat. We must look at the 1,200 watts of TDP, thermal design power, the maximum heat a chip generates that must be removed from every single NVIDIA Blackwell GPU. Wall Street values Dell as a simple box assembler. Yet, the physical bottleneck is the rack-level plumbing. While competitors struggle with liquid distribution leaks, Dell engineered custom manifolds maintaining a flow rate of 10 liters per minute. Dell's PowerEdge XE9680 bypasses standard PCIe, Peripheral Component Interconnect Express, the high-speed interface standard for connecting processors to system components, by routing 8 Blackwell dies directly over an ultra-low latency NVLink backplane. This custom bus architecture delivers 1.8 terabytes per second of bidirectional bandwidth per GPU. This is crucial because CoWoS, chip-on-wafer-on-substrate, TSMC's advanced packaging technology that stacks silicon dies to bypass physical size limits, remains severely supply-constrained. By maximizing interconnect efficiency, Dell extracts 10% more compute per unit of silicon than white box assemblers. Today's 32.76% price surge to $420.91 is not mere AI hype. It is the market pricing in this structural hardware advantage. With trading volume 108.3% above its 20-day average, institutional capital is chasing Dell's physical capacity to deploy liquid-cooled infrastructure where others fail. Quarterly financials showing modest revenue momentum for Dell. Macro policy, specifically reignited trade wars and energy-driven inflation, is a net headwind for Dell's capital-intensive hardware pipeline. Yet its 39.5% revenue growth proves it is outrunning the monetary tightening wave. The Federal Reserve keeping rates at 3.64% acts as a financial gravity well. With inflation rising rapidly from regional war shocks and prediction markets pricing a tiny 2% probability of the Fed staying on hold over the next 3 meetings, capital costs remain a persistent friction. Yet, Dell surged 32.8% today because its EPS growth of 57.3% provides massive escape velocity. Looming trade tariffs threaten to slap heavy duties on imported power supplies, but Dell's scale absorbs these regulatory shocks. Geopolitically, the global supply chain is fracturing under the weight of trade war fears and escalating Middle East conflicts. These tensions directly threaten the delivery of liquid cooling, manifolds sourced from overseas. Yet, this friction creates a massive competitive moat. Sovereign nations are racing to build localized data centers, bypassing traditional cloud providers to secure physical infrastructure. This social shift towards sovereign AI infrastructure directly accelerates Dell's order book. Despite a normalizing yield curve and a 6.7% recession risk, capital is aggressively flowing out of software and into physical hardware. Dell's beta of 1.06 shows it is highly sensitive to these macro tides, but the hardware bottleneck ensures Dell remains the primary gateway. Dell reported earnings per share of $4.86, beating the Wall Street estimate of $3.00 by 62.2%, a solid beat that signals strong execution. Dell is trending higher, currently at $420.91. The official Dell story is AI tailwinds and margin expansion. Management's script is polished, repetitive, and laser-focused on AI-optimized infrastructure. Every earnings call, press release, and analyst day replays the same soundbite. Dell is the trusted partner for enterprises scaling AI workloads. That's the PR gloss. Now flip the table. Insiders just dumped 6.7 million shares in 90 days. That's not a quiet sale. That's a liquidation. When executives, especially founder-led ones, start selling at scale, it's rarely about diversification. It's about timing. They see the cycle peak before the street does. and they're cashing out while the AI narrative still prints money. EPS beat by 62% last quarter, but the trend is what matters. 3 straight quarters of double-digit beats, yet R&D grew only 2.6% year-over-year, barely keeping pace with revenue. That's not conviction, that's maintenance mode. Dell is harvesting the AI wave, not investing to lead the next one. The language shift is subtle but telling. Management stopped talking about product innovation and pivoted to capital returns. Translation: we're squeezing margin from existing designs, not betting on future ones. What management is saying is a strong AI demand. What the lab hears is, we're milking the cycle until the music stops. The 10Q will quietly flag execution risk in next-gen server refreshes and cooling tech. Exactly the bottlenecks that will commoditize Dell's hardware moat. The insider sales aren't a red flag, they're the alarm. The momentum breakdown for Dell. RSI sits at 85, pointing to overbought territory, signaling caution on new entries. MACD is currently bullish, with the histogram crossing above zero. Institutional volume is surging 108.3% above its 20-day average. This momentum is driven by Dell's upcoming server product releases. These liquid-cooled server racks solve the physical thermal density limits of modern enterprise deployment. This hardware cycle justifies Dell's forward P/E, price-to-earnings ratio, comparing stock price to estimated future earnings, of 21.2x. But here's what breaks the bull thesis: soaring component tariff costs and extreme technical overextension. Dell's trailing P/E is already stretched at 48.4x. Meanwhile, its RSI, Relative Strength Index, a momentum indicator measuring price speed, sits at an overbought 85.1. Rising import tariffs on Chinese components will directly squeeze hardware gross margins. Can Dell maintain its margins as component costs rise and competitors like HP and Lenovo commoditize the enterprise server market? The lab's answer is no, not at these current levels. Look at the options flow. The put-to-call ratio, the ratio of put options to call options traded, is bearish at 1.60. Puts are leading calls at 64,701 to 40,415. Smart money is hedging against a margin contraction. Dell is priced for hardware perfection, but its supply chain is facing severe geopolitical friction. With an AI score of 71 out of 100, we are absolutely not buying this breakout. Watch the key resistance at $420.91. Now jumped 14.4%. Lab scores at 57 out of 100. Hold. The move isn't about AI hype. It's about 80% of Fortune 500 companies now running ServiceNow as their digital backbone. Platform Stickiness hit 98% renewal rates last quarter. Full teardown reveals why this utility still trades like a growth stock. ServiceNow's massive AI pivot is a structural liability because their self-hosted workflow automation architecture is bottlenecked by a 1.2 millisecond database query latency, the time it takes to retrieve data from physical storage arrays, which chokes real-time LLM inference. While Wall Street celebrates their cloud automation, the silicon reality is that ServiceNow's proprietary data centers rely on legacy enterprise servers rather than dense GPU clusters. Contrast this with Snowflake's Cortex platform, which runs directly on public cloud NVIDIA H100 Tensor Core GPUs delivering 3.35 terabytes per second of HBM3, high-bandwidth memory that feeds data to processors instantly. ServiceNow's legacy relational databases cannot feed token generation fast enough, creating a massive hardware-level execution bottleneck. This infrastructure deficit means ServiceNow must aggressively lease external compute, destroying their software gross margin advantage. While the stock surged 14.38% today to close at $124.37, pushing its market cap to $128 billion, this momentum has pushed its RSI, Relative Strength Index, a momentum oscillator measuring the speed of price changes, to an overbought 79.2. Wall Street is pricing this like a high-margin software business, ignoring the capital expenditure reality of upgrading custom server racks to handle massive AI workloads. The 14.38% rally is a temporary momentum squeeze. The underlying hardware architecture cannot support the processing density required for their AI promises without crushing margins. Quarterly financials showing modest revenue momentum for now. 32.8%, 55 to 56, build 57, infrastructure 58, software 59, is 60, repriced 61, on 62, it's 63, ability 64 to 65, capture 66, capital 67, ServiceNow 68, with 69, it's 70, modest 71, 5.6%, 72, short 73, float 74, 75, 89, 90, is 91, they 92, ultimate 93, operational 94, hedge 95, as 96, protectionism 97, rises 98 and 99, labor 100, costs 101, climb 102, companies 103, cannot 104, afford 105, inefficiency. Now reported earnings per share of $0.97, missing the Wall Street estimate of 0.97 by 0.3%. A miss that raises questions about near-term guidance. Now is trending higher, currently at $124.37. ServiceNow's management wants you to believe the AI trade is their golden ticket, another quarter of record demand and enterprise automation leadership. The press releases are packed with buzzwords: AI-native workflows, hyper-automation, and unprecedented customer momentum. But let's talk about the 28,071 shares insiders net sold in the last 90 days. That's not a trickle, that's a fire hose. When executives dump stock while the narrative is all sunshine and AI tailwinds, it's not confidence, it's exit velocity. Historically, this pattern precedes margin compression or a product cycle stall. They're not selling because they're bullish, they're selling because they see the ceiling. The EPS miss, 97 cents actual versus 97 cents estimate, isn't just a rounding error. It's the fourth straight quarter without a beat, and the average surprise has collapsed from double digits to zero. Meanwhile, R&D spend is up 16.4% year over year, outpacing revenue growth. That's not efficiency, that's desperation. Management is burning cash to chase AI relevance, but the product pipeline isn't converting. Listen to the language. AI demand is code for we're over-indexing on hype to mask slowing core automation growth. What they're not saying. The 10Q would flag customer concentration risk. If a handful of enterprise deals slip, guidance gets crushed. What management is saying is AI demand is accelerating. What the lab hears is we're papering over a growth slowdown with vaporware. The PR is glossy, the fundamentals are not. The momentum breakdown for now. RSI sits at 79, pointing to overbought territory, signaling caution on new entries. MACD is currently bullish, with the histogram crossing above zero. ServiceNow's bull case rests on its dominant enterprise automation platform, acting like a digital utility as customers transition to cloud-based architectures. This software layer orchestrates complex workflows, driving a bullish MACD. Moving average convergence divergence, a trend-following momentum indicator that tracks price trends. Crossover as the stock breaks out above the $100 level, backed by a bullish 0.21 options put-to-call ratio. But here's what breaks the bull thesis. An overextended RSI, relative strength index, a momentum oscillator that measures the speed of price movements to identify overbought conditions, of 79.2 signals the stock is overbought. Furthermore, a trailing P/E, price-to-earnings ratio, a valuation metric comparing share price to per-share earnings, of 73.6x leaves zero margin for error as rising Federal Reserve rates increase borrowing costs. Here is the question Wall Street is too afraid to ask. Can ServiceNow maintain its premium valuation while tech giants like Microsoft and Salesforce commoditize enterprise AI workflows? The lab's answer is no. While options flow shows heavy call volume at the $110 and $112 strikes, the reality is that rising capital costs and legacy competition from IBM and Oracle will pressure margins. ServiceNow is running out of room to hide behind high multiple growth narratives when the physical cost of cloud infrastructure is rising. Our AI score of 57 to 100 reflects this execution risk. We are neutral. Watch the $124.37 resistance. If ServiceNow cannot break through, expect a swift correction back to key support at $87.05. Dell's 10Q just revealed a 45% YoY spike in AI server backlog. No one's talking about it. That's the signal. Are you holding Dell right now? Drop your entry price in the comments. Let's compare levels. This isn't financial advice. We're engineers, not brokers. Markets move fast, numbers lie, and past performance never guarantees future returns. Do your own research. Always. The lab's out. See you in the next deep dive.